Good morning, everybody. I hope you had a good weekend, and it's cool where you're at, not boiling hot like it is a lot of places in the country. This is the best time to, as usual, to give us feedback, tell us what's going well, what's going poorly, ask any questions you have. I mean, this is a great time to share stories or share hurdles that you're having or triumphs that you've had. So everybody's going to appreciate and grow from that. So if you have any questions or concerns, please, as Jeff goes through the pointer, type them into the chat box there, and we will address them. And what Jeff's going to go through today is, I think, which is an excellent point that we need to keep in mind going forward. It's a way that we can either grow our businesses immensely, or we're going to crumble and disappear, as he's going to point out. And then we're going to go through, or Jeff's going to do an excellent, job of go through the power of attorney for us, so we can see exactly how that is to be done. So, Jeff, can you go through the pointer where we see if there's any questions?
Yeah, absolutely. And actually, the pointer that I'm going to go through is a little bit different today because I want to show the article that Mike is talking about. But today, I just want to talk about something that's been in the news and was in actually Financial Advisor magazine just this month. So if you're wondering what I'm talking about or you want to learn a little bit more, you can go out to the Financial Advisor magazine this month and look at an article called 4% of What. So there's something out there called the 4% rule, and I think a lot of brokers kind of adhere to the 4% rule. And I'm sure a lot of you on the call are familiar with it. And what it is brokers will tell people that when you retire, you can probably safely withdraw 4% of your portfolio adjusted for inflation and not run out of money. So sometimes the question comes up, well, where does that 4% rule come from? Well, it actually comes from a study that was done years ago by a guy by the name of Bill Bengen, B-E-N-G-E-N. And he did some research, and it was published in the Journal of Financial Planning. I can't remember when, but it's been 1993. That's when he did it. And from that was born the 4% rule. Looking back at 30-year time periods, he said you could withdraw 4% of your portfolio and not run out of money over a 30-year time frame. So he was recently interviewed, and he talked to the people at Financial Advisor magazine about his 4% rule, and the reason he wanted to come out and talk is he wanted to clarify some things. He wanted to point out that when he did his original work, he only had 38 complete 30-year time periods, and nowadays, if we fast forward to 2012, there are actually 57. And so he replicated his research, and guess what he found out? 4% probably doesn't cut it. So he's now recommending that the safe withdrawal rate isn't 4% anymore, it's 4.5%. But that even was before two brutal bear markets where within 10 years a lot of us have started to rethink some assumptions that we make about financial planning, including himself. And so one of the things that he's learned in the last year or so is that we should never assume anything. That's his exact quote, to never assume anything. And I think it was interesting to look at the article, and I just want to read something verbatim. Bengen concedes that the 1982-2000 bull market could be viewed as a freak accident, a product of the final years of a debt supercycle. So viewed in that light, the back-to-back bear markets of 2000 to 2002 and 2008 and 2009 could be interpreted as an inevitable consequence of the same cycle. So he says, looking back at my research, it's clear that 4% is not going to cut it. Probably we should go to something like 4.5%. But even that, we shouldn't assume anything. I mean, it's possible that 1982 to 2000 bear market or bull market that we saw, that might have been a freak accident. We may never see that again in our lifetime. So here's his rule of thumb going forward. His rule of thumb is this, and I quote, "When all else fails and markets produce unpleasant surprises, reduce spending pretty quickly. It's one of the few variables that clients can partially control." So guys, how much success do you think you would have with a retiree, someone who'd been retired 3 or 4 years, and say, you know, the market's down, I'm sure it's going to bounce back up, but my recommendation is just to cut your income in half for the next 12 to 18 months. After that, you can come back in and we'll revisit it, and maybe we can bump you back up. And guys, is that going to fly?
Nope.
And that's the extent of the financial planning that we do. So how can we use that? Well, Jason talked last week about a series of products. You know, when most clients come into you, I think if you ask them, you know, what do you think my job is? I mean, most people tell me it's to grow their money the best that I can. And then when they retire, send them the interest on that money. Now, why do they want me to send the interest and not the principal? And people are going to say, well, because they don't want to run out. They want to make sure that it's there, that it'll last forever. Right. So, guys, what we have, even after the changes that Jason discussed, are things that grow their money at 6 to 6.5% per year, guaranteed. And then when they want to dip into it, when they retire or when they want to start taking income, they can take 4.5 or 5% out. And that's guaranteed. They never have to take a pay cut, even if the market dips. So we have things that can grow at superior rates, guaranteed, and we have things that we can take a 5% withdrawal from and never have to worry about the market going down and having to take a cut in pay. So everybody that looks at this idea says they want that, at least for part of their portfolio. Because what clients want, this is what clients want, I think. They want a sense of certainty. They want to know what to expect. But guys, are they going to get that in the market over the next 10 years? Are they going to get a sense of certainty? Are they going to know what the market's going to do every year, more or less, for the next 10 years? And are they going to know, more or less, with any degree of certainty, what they can expect in terms of income? And the answer is no, they can't. But they want that. And this is a way to give that to them. So don't be shy about going out there and marketing, and don't be embarrassed or ashamed about what you have to offer. Because what you have to offer is something that nobody else can offer them, and that is certainty. And those are still good numbers. Growing your money at 6.5%, and then when you want it, taking 5% interest for the rest of your life. So that's a way to inject some certainty, and everybody wants that, at least for part of their portfolio. And I think that's why income rider products and indexed annuities are doing so well, record sales. So again, get out there and market, and don't be ashamed about what you have to offer. You have something that most people don't have to offer, and it's something that everybody wants. Even the most sophisticated advisor wants a piece of certainty in their portfolio. Any questions before we move on to power of attorney?
Yeah, why wouldn't a bond portfolio give that to you? I've seen a lot of guys, Jeff, who are certain that this fantastic money manager that uses bonds, and I just had a discussion last week with somebody and helped him understand why that was not the case. But a lot of money managers use bond portfolios for the secure part of their portfolio, and that's a huge folly to do that.
Yeah, it's a fault. Well, one, there's two reasons that's folly. One, let's talk about the primary reason, and we talked about it a couple weeks ago, is that bonds aren't guaranteed. And we talked about three things that were tailwinds that made bonds look good the last 10 years, but are going to be headwinds that are going to make bonds look bad the next 10 years. And most people think that we're in some sort of a bond bubble. And when it pops, you're not going to want to be there. The reason is interest rates cause bond values to go up or down. And we're in a very low interest rate environment, and we have been for a while. So bonds have looked good because interest rates have been a tailwind. But going forward, we're getting signals that eventually interest rates are going to have to go back up. And when they do, bond values are going to crash. The other thing that helped bonds in the last 10 years is the Fed. They were trying to put cash into the economy, and insert some liquidity. And the only way that the Fed really has to do that is to buy stuff and exchange it for cash. Well, what they were buying is bonds. And so there was a huge demand for bonds that drove the price up. But at some point, the Fed's going to have to sell those bonds back to take back that cash. Otherwise, we'd have runaway inflation. And when they do that, they're going to create this huge oversupply of bonds that's going to cause bond values to crash.
Now I'm going to jump in here, Jeff, because this gentleman that I was talking to said, yeah, but if you hold bonds to maturity, you get the principal back. And my point was, what's the number one objection that people have with annuities?
That the surrender charges are too long.
The surrender charge, liquidity, right? So how many of these people want to hold a bond for 30 years, 25 years, or 20 years? If the number one objection that they have for annuities with a 7-year holding period or a 10-year hold period or a 5-year hold period is still the liquidity, who in the hell of your, which one of your clients is going to want to hold something for 20, 25, or 30 years? Yeah, so the whole thing that bonds are safe if you hold them is a what kind of argument?
Yeah, it's a misnomer, and for the same reason, it's exactly what you said. You can't own if you have an individual money manager who's managing a portfolio, you don't own the bond. He owns the bonds in the portfolio, so holding them to maturity isn't even an option for you.
Nope.
And I'll tell you that most money managers are looking at the same things that we just talked about and saying, gosh, I don't know if bonds are really a good play going forward. You're not going to find very many tactical managers, and even tactical money managers are saying, I'm not sure about bonds as for the safe part of the money anymore. A lot of money managers are transitioning away from them themselves because that's how overinflated bond values have become in the last 10 years and how people in the know are really starting to question, is that really a good investment? It was, if you got in 10 years ago. But now going forward, that's not the place to put your money.
No, that's right. So going forward, growth is growth, and safety is safety, and bonds is not safety. So a portion of their portfolio in growth type of blue chip stocks or some sort of equities, terrific, absolutely. Certainly have part of their portfolio there. Have 25% or 30% or a third or maybe even up to a half in growth, but zero money belongs in bonds.
Any other questions? Any questions about anything?
Dale asks if can bonds be called?
Bonds can be called, sure they can. And so that's a conversation that you have with people because a lot of times if they own a bond fund or they have bonds through a money manager, they don't own the bond, and so there's going to be a lot of turnover and they are going to lose value when inflation goes up, when the Fed sells their bonds, when interest rates go up. They can't hold them to maturity. That's not an option.
Well,
but
Jeff,
for
do you remember?
Yep. Go ahead. For people who own the bonds, yeah, they will have a call date.
Yeah.
So they can be called. And then when you think about it, in a low interest rate environment, if the call date comes and goes and the bond doesn't refinance, what would that tell you? And the question you ask people is this, with interest rates the way they are, mortgage rates the way they are, what do all the homeowners want to run out and do? Refinance.
Yeah.
Why? Well, because it lowers their cost. And so that's the smart thing to do. Well, these bond issuers, would you think they have some smart people working there? Maybe some MBAs, some people with track records and experience, people who know a little bit about economics and what's going on? Sure they do. So with interest rates as low as they are, when they have the opportunity to refinance, what are they going to do? Jump on it, which means you're going to get your money back in an environment where you're not going to be able to find anything that pays very well to reinvest in, just what you wouldn't want. I mean, when you have a good interest rate, you want to keep it, right? But they're going to give you your money back and tell you, no, we're not going to let you keep it. Go back and try and find something in an environment where you can only get maybe 1.5% on a treasury.
Yeah. So the thing with called bonds is they give you your money back when you don't want it, and they keep your money when you do want it.
That, and if they don't call it, guess what that, you know, when a homeowner goes to refinance, do they ever have to fill out paperwork? Sure they do. Well, why? Well, because the bank wants to know when they give them the new loan that they can pay it back. See, they're going to either refinance and stick you with a crappy rate, or they're not going to refinance, and the reason they're not going to refinance is they couldn't get a loan. The bank says, we don't trust you for the money. We're not sure you're good for it. Is that really what you want to be invested in? Something that the bank says, I don't think you're good for it. So you have to be really careful with callable loans or callable bonds.
And you have to be careful with bonds, period. Do you remember, Jeff, when I got in an argument with several guys in the early 2000s about GMAC bonds, and I said, bonds are not guaranteed. This is not a AAA bond. This bond could go away. And they argued, no, 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 General Motors can never go away. This is a AAA bond, and they're high interest, blah, blah, blah. And what happened to GMAC bonds?
Yeah, they're gone.
Gonzo. And then we have another question. What about laddering? Laddering is fine when interest rates are up, but if you look at laddering right now, how can we possibly ladder with a CD or a bonds unless we're going out 30 years again? And even when you go out 30 years, what are 30-year bonds paying? Are they paying 6.5%, Jeff?
No.
Are they paying? No. So then it means only like a small portion of your portfolio would even be earning 3%, 3.5%. So right now, laddering bonds or CDs also, well, CDs is better than bonds because at least CDs won't go down in value. But you're not going to get any type of interest rate. You get a 6.5% interest rate from the first year on 100% of your money with the income riders. So why the hell would you want to ladder your bonds or whatever when if you went out 30 years, the most you're going to get is 3.5%? That's crazy. Are there appropriate times in history to ladder? Yes, is now one of them. You're nuts. Your safe money belongs in an annuity with an income rider. Your growth money belongs wherever you believe you can get the most growth in an equity, whether it's a blue chip stocks or some sort of whatever, that's fine. But your safe money to be in any types of bonds or CDs right now is completely ludicrous. The only place that makes sense is an annuity that's backed. Remember, annuities right now, and remember Jason went through this, are backed with they have to have 100% of assets backing up that, 100% plus backing up that entity. How many people have lost money in the last 100 years in an annuity product? Zippo. But how many people have lost money in stocks? How many have lost money in bonds? How many have lost money in real estate? How many have lost money in commodities? So unless it's FDIC insured or an insurance product, you're crazy to put safe money anyplace else. And right now, you don't want to be putting money into a bank. Just the interest rates are just so. Jeff, if they're going to use CD laddering or they're going to use bond laddering right now, do you think the 4.5% rule applies for withdrawal?
No, I don't think
What's going to happen?
No,
you're going to be pulling out more than you're making.
Right. Well, and like the author of the study said, the only thing that he knows for sure that works is taking a pay cut when you lose value in your assets. That's the only thing that you can control, and that's what you have to do if you want to guarantee that you're not going to lose money. If you're going to be in the market, then plan on taking a pay cut in down years.
Yep. And the bond is the market. Bonds are the market. CDs are not the market. CDs are safe. They're secure. They don't vary. But bonds are the market. Stocks are the market. Commodities and real estate are the market. So we kind of went long on that, Jeff, but thank you.
So power of attorney is the thing that we want to talk about today. And the question that I usually get first is, let me pull up my slides here. Are we even allowed to talk about that? Or is that something that is only for attorneys? Are we starting to tread on ground where we might be giving legal advice? And we can't give legal advice. But what exactly does that mean, we can't give legal advice? Well, what it means is we can't draft documents. So we can't create a power of attorney for our clients, and we can't tell our clients how to draft documents. So we really can't tell people, well, just go out to LegalZoom and here's what you need to put in that document. You can't do that. But what we can do is point people back to an attorney for advice. And we can make suggestions about things they should ask the attorney about. So we can't draft documents and we can't tell people to draft their own and what to put in them. But what we can do is tell people, go back to an attorney, and here are some of the things that you should ask the attorney about. Now when you think about it, attorneys are the ones who police the industry and whether or not people are giving legal advice that they shouldn't be giving advice on, giving advice on things that they shouldn't be giving advice on. So is an attorney ever going to jump down your throat and complain that you're telling people to go see attorneys and maybe have some of these documents redone by an attorney? Do you think an attorney is ever going to object to anything like that?
No, you're generating business for them.
Yeah, so they love it. They're fine with it. In fact, they want you to go and do that. And when you think about it, what are powers of attorney for? I mean, what you're going to find is generally what they're for is withdrawing money. They enable people who can't make decisions for themselves or can't handle their finances themselves, whether because they're mentally or physically incapacitated, to allow somebody else to do that for them. And that means paying bills, taking money out of accounts. And if it's our job to not only grow the money, but make sure our clients have access to their money, then we might even have an obligation to point out places where that might be a problem, where they might not be able to do that. I mean, there might actually be, for some of you, you have a fiduciary responsibility. For those of you that aren't licensed and don't necessarily have a fiduciary responsibility, you're going to find that increasingly as the years go by, you are going to be required to have fiduciary responsibilities. And when that happens, that's going to be one of the things that you're actually going to be required to look at. Can they get to their money when they need it? And that's really what powers of attorney are for, making sure that you can get to all of your accounts when you need to, when something bad happens. And we have an obligation to our clients to not only grow their money, but make sure that they can get to the money that they have with us, and really all of their accounts. So what would be the issues? Why might somebody not be able to get to their money if they have a power of attorney? Well, the problem is powers of attorney are easily changed. So if I've got a power of attorney, and if I wanted to change it, it's just a matter of me making a phone call to my attorney and going down there and signing the documents, and presto changeo, it's done. Now there's one that overrides another because it's newer. But do I have to let the bank know that? Do I have to file that anywhere with the county clerk? No, I don't. Do I have to even tell my wife? I should, I would, but you don't have to. I mean, they're so easily changed. And so again, we talked about the fact that they're not used to put money in the bank. They're used to take money out of the bank. They're not used to put money into a brokerage account. They're used to take money out of a brokerage account. And so if somebody who's not the account holder wants to take money out of the bank or out of the brokerage, do you think the financial institution might have a little liability there? Yeah, they do. They have a lot of liability there. So they're going to do some things to limit their liability because they know these things are easily changed and they have no way of knowing whether they're honoring the right power of attorney. So one thing they're going to do is they're going to say, well, it has to be new. And by new, we mean within 2 years old. Because if it's 30 years old, there's a lot of possibility that it got changed sometime in the last 30 years. If it's 10 years old, there's less possibility, but still a lot of possibility. If it's 2 years old, yeah, I suppose it could have been changed, but at least we can make a case that it's highly unlikely. So we're not going to honor any powers of attorney that aren't 2 years old or less. If it's more than 2 years old, we just won't honor it. And think about it, guys. If I walked in with a 3-year-old power of attorney to the bank and the bank said, geez, this is a little bit old, we're not going to take it. Well, what would my options be? Well, I could go to a court. And I could tell the court, hey, I went to go take out money out of this bank with this power of attorney, but they say it's too old and they won't honor it. And the court can look at it and do some due diligence and do some research and see if they can't be reasonably convinced that the bank should honor it. And 9 times out of 10, they're going to tell the bank, hey, he went to court, we looked into it, you have to honor this. So when I go back there with the court order requiring them to honor it, guess what they'll do? They'll honor it. But what was the penalty for not honoring it the first time? There's no penalty. And not only that, now the court has all the liability, not the bank. So guess what the bank's going to do every time? Since there's no penalty for not honoring it, and it takes all liability off them if you come in with a court order, guess what they want you to do? Go get that court order. They just don't honor it. They'll only think about honoring it if it's new, less than 2 years old in most cases. That, and a lot of times what they're doing these days is they're saying, well, it has to have institution-specific language. So here's what that means in everyday language, in real terms. If I go down to Wells Fargo and I want to take money out of a Wells Fargo account that's not in my name, but I have power of attorney, you know what they're going to want in that power of attorney? Language that says, you can take money out of a Wells Fargo, out of this Wells Fargo account with this number using this power of attorney. And if you don't have that language in that power of attorney, guess what they'll say? We don't honor this. It doesn't have the language we require. It's not on our power of attorney, or doesn't have the language that we require for other powers of attorney. So we're not going to take it. Then guess what you have to do? Go back and get a court order. And what's the penalty to the bank? No penalty. And now they don't even have any liability.
Jeff,
so
can I jump in here a second?
Sure, go ahead.
Yeah. And guys, just so you, I just want to emphasize here, because I've seen guys take what Jeff is covering here in the wrong way. What Jeff is covering here is for your ears only. Should you be covering this, Jeff, with the client?
No.
Not at the second meeting. If you cover this with the client and tell them, here's all the things wrong with your power of attorney, here's all the things that can happen with your power of attorney, what have you just told them, guys?
How to
told
fix
them what the problem is. Yeah, so yeah, you told them what the problem is so they can go back and fix the problem. So what Jeff is doing here is strictly to help you guys understand why what we're doing with the power of attorney is important, and why they basically every single power of attorney we sit down with has problems with it. But I just wanted to emphasize, this is for your ears only. Don't do this with the client. Not that it's bad that if you do it with the client, but if you did it with the client, they have no reason to come back to you because you told them what the problem is. So I just wanted to emphasize that, Jeff.
Yep. And a lot of times people will ask me at the end, well, now that they're a client, what are the things they need to talk to their attorney about? These are the things that they would talk to their attorney about after they become clients, not before. Okay, so these are for your benefit, because what we're going to end up telling people is there are problems with your power of attorney. Now, here are a couple problems that would probably affect 95% of all powers of attorney. 95% either were done more than 2 years ago, or even if they were done within the last 2 years, don't have the language required by the institution. So, and it's a problem because Wells Fargo has their own language. Bank of America has different language. TD Ameritrade has language different than Merrill Lynch. So, I mean, you have to have language specific to every account. In fact, even some of the annuity holders, if you called them, I know Lincoln for one would say, yeah, it has to be on our power of attorney if somebody wants to take money out of this account that's not the owner of the annuity. So be careful with this, guys. That's 95% of powers of attorney. But what about the rest? Well, gifting language. And gifting language will always be a potential problem. And here's why I say it's a potential problem. Powers of attorney really only do two things. Something happened to you where you couldn't handle your own finances. They do first what they do is they name somebody else to act in your place. Could be your wife, could be a friend, could be another relative, could be your brother or sister, but you name somebody to take care of those things for you if you can't take care of them yourself. So that's the first thing it does, is it names somebody. But then what it does is it says, are there any limits to what the person that I just named can do. And generally, the only limit that a boilerplate power of attorney will include is this: whether the person can gift to themselves or not. Can they make gifts to themselves? Well, most, not all, but most will say no, they can't. The reason that we're not going to allow them to make gifts to themselves is there's too much potential for fraud. I mean, if I gave power of attorney to my brother, and my brother's a good guy and I know he wouldn't do this, but there's the possibility that he could take the money and gift it to himself to buy himself a car, or gift it to himself to send himself on vacation. And so even though I know he wouldn't do that, the attorney doesn't know that, so he's probably going to include language that says he can't gift to himself. Well, that could be a problem. That could be a problem because let's say it's a husband and wife, and the wife needs money out of the husband's IRA. So the husband's incapacitated. He can't take money out of the IRA because he's mentally unable or physically unable. And so the wife calls up the company and says, hey, we've got a lot of medical bills. I need some money out of this IRA. And the company says, yeah, but it's your husband's. It's not yours. Yeah, well, no problem. I've got power of attorney. Well, let us see it. Okay, yeah, looks like you have power of attorney, but it says here that you can't gift to yourself. We can't give you money. That's a problem. Or if she wants to sell the house, they're there to sign and sell, and the real estate agent says, well, all we need is for Bill to sign. Well, Bill can't sign. He's in the hospital. He's in a coma. But I have power of attorney. Okay, no problem. Oh, wait a minute. It says here you can't gift to yourself. That means you can't give Bill's portion of the house to yourself to sell it. You can't sell. So that's what happens most of the time. Some of the time they say, well, you know, we're going to go ahead and let the person gift to themselves. We'll get around that problem by letting them gift to themselves. But what's the problem with that? Well, the potential for fraud that we talked about earlier. The potential for abuse. So there's always a potential problem with the gifting language. Now, that doesn't mean there's going to be a problem. That just means that there could be a problem. But should they have the information to make their own decision, or should we just leave them in the dark and hope for the best? I mean, at the very least, I think people would say, well, give me the information of the potential problems, and then I'll decide which way is going to be better for me. And that's our job, is to highlight potential problems. So how will we know if any of these problems exist? Well, we'll know there's a potential problem. We always know there's a potential problem with the gifting language. We know for certain that if all else fails, there's that as a potential problem that they need to be notified about. And we can also see if there's language specific to their brokerage accounts or their banks inside the power of attorney. If there's not, that's a big potential problem. And we can quickly look and see when it was done. If it was done more than 2 years ago, that's a potential problem. So we can quickly look at these documents and within 1 or 2 minutes know whether there's a potential problem. If I look at the date and it was done in 1998, I already know there's a potential problem. If I look at it and it makes no mention of any banks or brokerages, just boilerplate language, I know that's a potential problem. And even if I didn't look at it at all, I know that there's a potential problem with the gifting language. So we know that there are problems with every power of attorney. And if you guys have questions, just stop or Missy, just stop me and ask.
Yep, so far so good.
Okay, knowing that every power of attorney can have problems, when and how do I bring that up? Well, we do bring it up in the agreement meeting briefly. Again, briefly, because my goal here isn't to divorce them from anybody at the agreement meeting. It's not to prove to them that there are problems with things. It's to get them to want more information so that they're able to make a commitment to me that they'll work with me if, in fact, it turns out that there are these problems. So we bring up a lot of things under the areas of opportunity and concern, and one of them is the power of attorney. And we tell people that there are statute changes and rule changes in rules at the banks and the brokerages that might affect your power of attorney. And I say might because that, if somebody said, I just had it done 3.5 years ago by the very best attorney in town, there can't be a problem with it. This guy is tops. Well, if there were rule changes or statute changes in the last couple of years, might there be a problem? Yeah, I guess there could. I suppose there could. Might you want more information? Yeah, I guess I would. So you can do this 100% of the time. And it's that might that always gets people thinking, well, maybe it would be good to have the information. So, yeah, let me hear what the guy has to say. I'm open to listening to how would it work? What's the deal? What would be the commitment that I'd have to make? Okay, so we bring it up briefly in that agreement meeting, but where we really bring it up and where I really want to focus the time is on that disclosure meeting. And to do that, I'm just going to go through the script that's on the website. So if you're wondering, where do I find the information? Where is Jeff getting this from? I'm about to do it. I'll go through it, but it's out on the website. If you go out to the website and look under the disclosure meeting, power of attorney, the script for power of attorney and an audio on power of attorney is right there on the website for you to be able to read and learn so that you can go through it with clients the way that I'm about to do it on the call for you. So I'm just following the script. Okay? And like everything that we do with a disclosure topic, the very first thing we talk about is all the things that they're doing good. So when people come to see you, I would say most, 2/3, maybe more, 3/4, are going to already have a power of attorney. But what I'm going to do is let them know that there could be potential problems. And like we talked about, the biggest problem, whether it's gifting language, whether it's being too old, whether it's not having the language of the institution embedded in the power of attorney, the real issue comes down to they're not going to let you take your money out because of that. They're not going to let you take your money out because of the gifting language. They're not going to let you have your money because it's too old. They're not going to let you have your money because it doesn't have Wells Fargo written somewhere in that power of attorney. You're not going to be able to get your money. That's the real problem, and that's what I want people to tell me. That it's important that we get our money, and we might not be able to get it, and that's a problem. Something that we weren't aware of before. And we're going to talk about why perhaps they haven't been aware of it in the past. So this script gets them to tell me that we might not be able to get our money. It's really important that we do be able to get our money, and no, this is the first time we're hearing this. But I always start by letting them know that they've done a good job just by having one. Now, we'll talk briefly at the end. What if they come in? What if they're part of that 25 to 30% of people who don't already have a power of attorney? You can still do this, and we'll talk about how I modify it just a little bit at the very beginning for people who don't have it. But let's talk first about the biggest group, which is the people who generally do have it but aren't aware that because of some things that are going on, they might have a problem accessing their money. So what I'll do is I'll talk to them and say, the next thing I want to talk to you about is your financial power of attorney. Now you have one, and that's a good thing. And I really want to congratulate you for having that in place. It says to me that you're very forward-thinking, that you care about your family, you care about, making sure everything is taken care of and all the I's are dotted and the T's are crossed. So having a power of attorney is really important. And you'd be surprised how many people I see that don't have one, but the fact that you have one, congratulations. You've done a great job by having that power of attorney. And so I guess it would be helpful to start by asking, why do you suppose people get powers of attorney in the first place? And typical answers are, well, they just want to make sure that, if anything happens that, they're covered. It'll be something ambiguous like that. And if you get that, you acknowledge it. Yep, that's exactly right. And when you say that things would be taken care of or that they would be covered, I mean, what kinds of things are we really talking about? Are we saying that, we'll make sure that the trash continues to get taken out or that the dishes continue to get done? Is that the kind of thing we're talking about? No, we're talking about bills getting paid. Right. And do you think that power of attorney is more for when everything's fine or when things are bad, when you're maybe physically or mentally incapacitated? Guys, what are these things for? They're not for when you break a leg. They're for when you're in a coma or when you have dementia. So it's for when things are bad. Right. So I'll use an example of myself. Like Mike talked about, earlier, if something bad is going to happen, I want it to happen to somebody else or to me. I don't want it to happen to them. Because they'll internalize it and start thinking things like, well, I don't think that would really happen, or I know what I would do. I just want them to be focused on the issue, so I'm going to use myself. So let's say, right, powers of attorney are really for when things are bad. So let's say I'm crossing a busy street out here that runs by the office, and I get hit by a bus. What would happen if I ended up in the hospital unable to take care of things and I didn't have the power of attorney? Now you have one, so congratulations, but what if someone didn't have one and they got hit by the bus? Then what would happen? I'm not sure. Well, you'd think that since I've been married all these years, they'd let my wife handle everything, but do you think they just let her? I mean, have you ever tried to deal with the cable company or the cell phone company if your spouse's name isn't on the account? Yeah, they wouldn't even talk to them. So how do you think the places I keep my money are going to deal with them when that happens? If that's how the cable company deals with it, how do you think the bank's going to deal with it? You think they're going to be easier or more difficult? Well, I'm sure they're going to be more difficult, right? And without that power of attorney, my wife couldn't get to the money short of going to the court and getting guardianship over me. But that's a long and complicated and expensive process. That can take 6 months and cost thousands of dollars in attorney's fees and court costs. And do I really want my wife to have to go through that? No, you probably don't. And really, would anyone want their family to have to go through that, the courts and the attorneys, when it comes to personal matters? No, not if they could help it. And that's why it's so important to have that financial power of attorney in place, because with that, my wife doesn't have to worry about any of that. And that's great. That's exactly what it's for, to make sure that she doesn't have to go through and jump through those hoops and pay those costs. That we've already thought about that, and we've taken care of that. And that power of attorney allows her to do what? Well, get to the money to pay the bills. Right. And then again, that's why we have it to begin with. So let's say someone came to me with $10,000 to invest, and I was able to take that money and grow that to $100,000. How would that be? Well, that'd be great. Yeah, I think that would be good too. But let's say someone else came to me with $10,000, and in the same period of time I was able to grow it not to $100,000 but to $50,000. How would that be? No, probably not as good. Yeah, not as good, but it's still okay, because as an advisor, what is my job? Why do people come to me? What do they hope that I'll be able to help them do? I'll help them manage their money. Yeah, and not just manage it, but actually do what with it? We'll help them grow it. Right. So, when I grow it to $100,000, I'm doing my job, right? And if I grow it to $50,000, it's not as much as $100,000, but am I still helping them to grow their money? Yeah, you are. Right. But let's be honest, if you had the choice between $100,000 or $50,000, which are you going to choose every time? Oh, the $100,000. Of course. I mean, everybody would choose that every time, and why? Well, because it's more. Yeah, absolutely. And we want to grow our money the most that we can, within parameters of risk and that kind of stuff, but all else being equal. If we could grow our money more, we'd what? Oh, we'd want to do that. Right. So if we had two accounts, each starting with $10,000, one grows to 100 and one grows to 50, we're going to choose the 100,000 how often? Well, every time, right? But let's say there was a catch, because there's always a catch, right? Would you want to know what the catch was? Oh yeah, for sure. Well, the catch is this. The $100,000 account, you can't get it when you need it. When you don't need it, maybe you can get it, but when you really need it, no way. Off limits. Can't get it. Locked in a vault. You have absolutely no access to it. On the other hand, the $50,000 account you can get anytime. Good times, bad times, in between times. You need it, you don't need it. Anytime you want it, you can have it. I mean, in that example, which account would you choose? And they say every time, well, in that case, I would take the $50,000 account. And I agree with you, I would too. And why is that? Because, let's be honest, $100,000 is more. But they tell you, well, but it doesn't do you any good if it's locked up and you can't get it. I agree. And guys, this is key. Because growing your money is important. You want to make sure you grow your money, but what's just as important? And they tell you, well, being able to get to it. Yeah. You need to be able to get to your money. And when is it even more important to be able to get to your money? When things are good or when things are bad? Well, it's probably even more important when things are bad. Right. And the reason I spend so much time talking about this is, what kind of an advisor would I be if my clients couldn't get to their money when they needed it? Now, I'm talking about myself as an advisor, but who am I really talking about? I'm really talking about other advisors, and in particular, their guy. But I'm not having to be accusatory because I'm saying, what kind of an advisor would I be if my clients couldn't get to their money? They tell me, well, you wouldn't be a very good one. And I agree with you, because my clients should expect that I can help them grow their money. But they should also expect that if they ever needed that money, that what? Well, that they could get to it. And this power of attorney document that we're talking about is really the key to being able to get to your money, especially when times are bad, because there's no issue when things are good. It's when times are bad and you're not able to handle the affairs that this is the only thing that stands between you and not being able to get to your money, which could cause a lot of problems. In fact, I won't even take a client without a power of attorney because, again, what would happen if my clients get to their money when they needed it? Well, they'd be in trouble and you'd probably be in trouble too. Yeah, I agree. And I guess that's what concerns me, because in a brief, very preliminary review, and I haven't had time to go through your power of attorney with a fine-tooth comb, but glancing through it quickly, there are a couple things that I see that would prevent you from getting to your money when you needed it the most. So now, are they worried that they might not be able to get to their money? A lot of times they want to know, well, what would be the problem? What do we have to do? And if that happens, then you've done your job right. Because when they start asking things like that, they're worried. They're acknowledging that it's a problem, something that needs to be fixed. And this is our first real kind of foray into getting them to tell me that maybe they're not working with the right guy. Now, with a power of attorney, I'm not going to be able to go for the throat necessarily, because did he draft the document? No. And so people are going to, at first, do they really want to believe that the guy that they trusted and handpicked isn't doing his job? No, they want to believe that he is doing his job. But I have to start to wade in there slowly with a number of topics presented in the right order to get them to say, it's possible that he's not looking at the things that he needs to look at. And then graduate to, These are things he should be looking at, and he's not doing it, and then graduate to, you know what, this guy is ripping me off. He's doing this on purpose. But this is my first step when saying, you know what, powers of attorney are access to money, which is something that he should look at. He didn't draft it. But you wouldn't be a good advisor if you didn't look at it. Your clients couldn't get to their money. So what does that say about somebody who doesn't look at it? That maybe he's not being the best advisor because you might not be able to get to your money when you need it. And guys, we can say that with confidence because we know it's either too old, doesn't have the language for the institution, doesn't have the bank language or the brokerage language that it needs to have for them to honor it, or there's a potential problem with the gifting that they aren't aware of. And when will I bring up the solutions or the things that they need to go back and talk to their attorney about? Before or after they become a client? After. After they become a client. After they become a client, I'll hook them up with the attorney if they don't have one, or I'll tell them what to talk to their attorney about. After they become a client, I'll help them with their titling and get that straightened out. After they become a client, I'll help them fix their beneficiaries. After they become a client, I'll help them with all those other things. But I don't do that for prospects. I do that for clients. Any questions anybody has? There's a guide on the website, too, that goes into more detail about the problems with powers of attorney, but what you really need to know and you really need to internalize is every power of attorney has potential problems, and it's okay for us to raise those issues, to talk to them and alert them to the fact that there might be a problem. In fact, some of us have a fiduciary responsibility to do it. And an attorney is always going to tell you, yeah, by all means. See if there are any issues and have them. As long as you recommend that they go back to an attorney to get it fixed, then yeah, go for it. We encourage it.
And that guide that Jeff was talking about is actually underneath the power of attorney section, so underneath disclosure meeting and power of attorney, and it's just called the Durable Power of Attorney Guide for Agent Use Only. So that's where you can find that.
And guys, this is one of the big three. So when it comes to the disclosure meeting, the three that you need to be able to nail, first two are a power of attorney and beneficiary. So if you can get those two, power of attorney, beneficiary, just nailed exactly how they're supposed to be done. Just like Jeff gave you an overview here, but if you go to the script, you see exactly how you're supposed to do it. If you can get that, those two, the power of attorney, beneficiary, and then if you're securities licensed or an RIA, the fee portion, or if you're not securities licensed, then the tax portion. If you could do those three things, power of attorney, beneficiary, and then if you're a securities licensed, the fees. If you're not securities licensed, then the taxes. If you can do those three things, you now have 70% of the disclosure meeting done. You're going to get 70% of the benefits of the disclosure meeting. If you are excellent, if you're an expert at doing those three things, you're going to see your closing ratio go through the roof. You're going to see people who you thought weren't qualified and would never do business with you moving all their money to you. You're going to see people who love their advisors all of a sudden not love their advisors and move all their money to you. Those are the big three you need to be experts at. And then as soon as you get those mastered, then you can start to look at other ones as well. And if you're struggling with any of these things, please call Jeff, call myself. We're more than happy to work with you. Set up an appointment for a half hour or an hour, and we'll work with you till you get it down. I've done that many times with guys, and when I've done that, they've gone, now I get it, and they just instantly are able to do it. So you need to be experts at this. These are the things that caused me to go from struggling to making more money than I knew what to do with. Okay? So concentrate on this. This is summer. You've got some downtime. Now is the time to master power of attorney, the beneficiary, and fees if you're a securities license, or taxes if you're not. And And we also have training on taxes. So if you don't know how to do taxes, you can give us a call. We'll set up a time to walk through how you do taxes, but we also have training on the site for that too. Okay. So any questions, concerns, problems? Oh, we have a question from Mickey.
Yep.
What is that? I can't see it.
It just says, I'm not securities licensed. Must I not discuss fees or turnover, etc.?
According to the rules, if you want to look at the rules, you can interpret them either way. You can interpret that you can, and you can interpret that you can't. So it says in the rules that as an insurance-only person, that I forget what that. You know what, Mickey? We'll send you the article that tells you exactly what you can and cannot do. But in there it says that you cannot discuss specific investments. You cannot recommend investments. You cannot make recommendations on what type of investments they should sell and what type of investments you buy. But you can discuss public disclosed data. That's what it says. Now, when it comes to you talking to a regulator, you better be very comfortable about what you can and cannot say. So the best thing to do is we'll send you that article, and can we make sure he gets that, Missy?
Yep, Mickey, I'm actually just sending it to you right now.
And then talk to your compliance attorney and get their opinion on that as well. So I have insurance guys that do talk about turnovers, fees, etc. And I have insurance guys who would never talk about fees, turnover, etc. So you're going to have to determine what you're comfortable with. So good question, Mickey. Other questions, guys? Concerns? Anything, Missy?
Nope, there's nothing else coming in.
Jeff, thank you very much for helping us out today. And guys, again, we're here to help you. So if you've got questions or concerns, pick up the phone, call us, or sit down at the computer and email us. We're here to help. That's why you came on board. So I appreciate you all, and hope you had a good weekend and a good start to the rest of the week. Thanks, everybody.
One other question. I'm sorry.
Yes.
One other question just came in with Mickey. He said, can I show them the analysis numbers?
The analysis numbers.
And he just disconnected, so I can't get any more information. Yeah. Oh, you know what? I think that goes back to his discussing the fees. So I'm guessing he's talking about the fees portion of the proposal.
Well, that goes back to the same answer I just gave him.
Okay, I'll address that in my email to him too.
Okay. Okay, thanks everybody.
Okay.
Have a good week.